Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's Thursday, April 12th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So my water heater in my house broke a few days ago. So I had no hot water. The tank started leaking water into my garage. And like most leaks, it got worse with each passing hour. That was my first experience with water heaters, so I did a normal thing. I called the number on the water heater that said, have problems with this water heater, call this number. And look, you may think I'm smart when it comes to analyzing stocks and things like that. Doesn't mean I know everything about anything, right? I'm just like a normal guy. So I call the number, and it's Sears. That's the first red flag. Since this is a water heater purchased by the previous owner of my house, so it's over 8 years old. And since then, there are barely any Sears stores around anymore. So again, red flag number one. So the lady gets on the phone with me. I give her the product number, which is on the tank. She says that she's going to have a guy come over tomorrow to take a look. I said, is there any way you could do it today? Because it's leaking a lot. It's getting worse. The earliest we could do is tomorrow. I said, fine. So the lady asked me for my credit card because she said, hey, it's going to cost $79 to get a guy out to you. That's the second red flag. Now, I asked her, do I have to pay really before the guy shows up? Because this is Florida, and there's one certainty I realize living in Florida. It's a guarantee. You never, ever, 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 ever pay someone before the job is done, because you will never, ever, ever, ever see that person ever again. It's true. It's the Florida handbook for the home repairs by people you don't know. I don't know what, but happens every time, right? It's a guarantee. So she says, sorry, but you're going to have to pay now. I can't send the guy out to you unless you pay. So I leak a water heater that's broken. I have no choice, right? I'm like, okay, here's my credit card. There you go. Fine. Just for me, I'm hoping the experience is going to be different from my previous 20 when it comes to people working on my house. So talk to my wife. She's able to meet the guy at the house since I'm working. I give her a call. And the lady told me that the guy coming is going to be there between 8 a.m. and 2 p.m., right? Which is like saying, hey, we hope you have no life and stay at home during peak working hours every day, right? From 8, not a 2-3 hour period, 8 a.m. to 2 p.m., right? That's the spread. So I was like, all right, I'll do everything I can to be home. It's not a problem. I also asked the lady if the guy give me a call before they come, because, listen, my wife is a busy woman and may have to run out here or there. This way she wants to make sure she's home. Maybe you can call when he's 20 minutes from the house. She's like, sure, no problem. So I wind up giving her my credit card. Just before I hang up with this lady, she tells me, oh, by the way, great news. You just qualify for a free in-home inspection, which includes floors and windows, right? That's red flag number 3. Okay, I'm getting pitched by a customer service lady who didn't even call the guy yet, right, to come to my home with my water heater spilling water into my garage, and she's pitching me like, hey, you want to? I was like, lady, just fix my freaking water heater. It's leaking. She's like, okay, wait. You also qualify for, before she says another word on another sales pitch, I said, listen, I'm going to hang up on you in about 3 seconds. I said, I need someone to come to my house immediately. Please come to my house. Call the guy. Maybe he can come today. If not, he's going to come the following day. She said it's going to come tomorrow, right? I'm hoping that maybe they can get some guy to come earlier than that, but I'm like, please, just go. So I said, she's pitching me, go crazy, and I'm really getting pissed off. So anyway, they don't get anyone out to my house the first day. So second day they come. And he shows up at 1 p.m. Not 8 a.m., right? But 1 p.m., like the later part of the day. So, of course, he doesn't call before he shows up like they said they were going to do. Guy walks in, says hello to my wife, looks at the water heater, says it's broken, then leaves. That's my fault, right? I'm the idiot. I should have known better, because it's completely normal in Florida. The guy got paid already. He may have actually paid his friend $20 to take his truck to my house while he watches The Price is Right or something like that, and say, hey, I just tell him it's broken and leave. I mean, it's kind of what I would do, right? Since I live in Florida, it's how people do business here. It's a culture. Why don't I join it? The one good thing the guy did do is he called the number to the warranty department. And they got back to me later that day and said, hey, good news. Your heater's covered by 2 more years. It's basically 10-year warranty, right? So it's, again, we have this house for about 7-8 years. So I'm like, good. And he asked me, hey, The only thing we need is the receipt. I said, sure, you need the receipt. I got it in my back pocket. Wow, how lucky I am. Who gives the receipt of every appliance that they bought from the previous home? I said, I had the inspection, which has pictures of it and showing that, hey, here it is. I just gave you the model number. I had one of your guys come over and verify it's in my house so you know it's there. But they said, we can't honor that warranty unless we have the receipt. Obviously, I don't have the receipt. I don't know anyone who have receipts of appliances or anything else. Usually you take pictures, you list them all in the closing or whatever. That's not what they want. They want the actual receipt of purchase. So I'm really pissed off. Because when you look at this, when warranties, insurance, right, they all have these numbers of how they could screw you as much as they can, right? Everybody knows this. And when you look at the average person, they stay in their home for about 7 years. So, they know this, and they put a 10-year warranty on their products, knowing they probably only have to cover them for 7 years on average. Again, we're looking at maybe hundreds of thousands of these things. But they have all these statistics and all this crap. And, I told the Sears guy this. Listen, you run a crappy, shady service. You really need a receipt. You know that this was purchased. I purchased the house, which means I'm taking over everything from this house. You should honor it. They wouldn't honor it. But the story gets even better. And stay with me here. Because I go to Lowe's and Home Depot now, right? So now I wasted a full day. Things really leaking. My garage is getting shot now. Go to Lowe's and Home Depot. Both places have to tell my whole entire story to them. Remember, Sears at a picture now, $79. They're not going to cover it. I'm like, the hell with you guys? I'm not doing business, right? $79 for the guy to come out and tell me that, oh, it's broken, go back in his car, go home. That's what happened. Home Depot, Lowe's, I thought it would be different. So I need someone to go to my house, take a look at the water heater. I told them I'm going to buy a new one and you install. You install it. That's $1,000, $1,200 job minimum. And they have no clue. They have me in the store forever. They can't get a guy or call a guy to come to my house. They had nobody in these stores. I'm talking both Lowe's and Home Depot. They knew anything about water heaters. And they had no idea who to call to get someone to my house, even though these places have emergency installation services. I mean, if your HVAC system shuts down, if your roof collapses and it's leaking, these are common things people fix right away that you can call Home Depot. They have emergency services for this, including water heaters. They had no idea who to call, what to do, anything about water heaters. They didn't even know what aisle to tell me to go to, and I don't know anything about it. So I wasted about 2 hours at these places, and I wound up calling a close friend in my neighborhood who is, used to live in the Northeast and flips houses and does great. And he happened to be at Home Depot at the time and said, Frank, don't worry about it. I'll take care of it. Bought a water heater for me. Installed less than 2 hours, all for less than $600. He put everything on his card to give me a check when you get a chance, just like, you would normally do business with people that you do business with, and fixed it. Now, is this situation normal? Because when I think a lot of people are idiots, sometimes I have to look at myself and say, maybe everyone else is normal and I'm the idiot. So maybe it's me here. But what I see when I see things like this, people hate money. Not that they have to be greedy, but you have to feed your families. I'm trying to hand you money at Home Depot. I'm trying to hand you money at Lowe's. I'm trying to hand money to Sears. Well, not really, since you've been cut under the warranty. But I'm trying to do business with you, and you're not doing business with me. And I just don't get it. And it's not a joke. It's like trying to tell someone the God they believe in doesn't exist. It really is a religion, a cultural thing here that I don't think is ever going to change. Maybe I just hope one day I kind of get used to it. But calling one guy, one friend did it in 2 hours compared to wasting 2 full days, and now I have damage to my garage. The fun stuff that I have to go through. So all you guys in the Northeast that are freezing right now and tell me the weather's bad, well, the weather's better here, but we have other problems to deal with. Anyway, I have a great podcast for you this week. Do a lot of special new guests lined up over the next few months. But this one guest I'm interviewing, you should be familiar with, since he's given you a ton of winning trades over the past 9 months. In fact, I don't know one trade he's given you that has not been a big winner. That person is Michael Alkin, former hedge fund partner, who I hired about 6 months ago and is now the editor of Moneyflow Trader, a newsletter designed to help you profit when stocks fall in value. But I'm not bringing him on to pitch Moneyflow Trader. Those of you subscribers to the newsletter, very, very happy considering almost every one of Alkin's positions been triple-digit winners since we launched the product in December. So a lot of you happy. I pitched that hard. That was the reason why. I'm glad you guys are making money. It's not going to be about Moneyflow Trader. This interview will be one of the best of the year. I'm not hyping this up because Mike's a great analyst, and we have different opinions on where the market is heading. And we're both passionate when it comes to our research. We're going to provide a lot of facts to support our thesis. We're not going to have a fist fight on air. It's not going to be about that. We're close friends. But we're going to explain how even though we have different opinions on the direction of the market, how we can both be right when it comes to our individual stock recommendations. And it's going to give you a wealth of knowledge on how to look at this market if you're bearish or if you're bullish, because you can make money in both markets. Now, trust me on this. You're going to learn more about stocks in this segment than you will reading any investment book. And we'll provide tons of stock ideas to buy and to short just from this one segment. In my educational segment, I'm going to show you why and provide my evidence why stocks are heading much higher this year. In fact, I'm going to break down why the S&P 500 is cheap. Yes, I said cheap, which I may be the only person on the planet with this thesis, making me a contrarian. Kind of weird, right? Because a contrarian play right now is to be bullish. Since everyone I know, everything I read, almost every analyst on CNBC, even past bulls like Tom Lee, Paulson, and these guys are like, well, we're bearish on the market. You could see a pullback. You're not seeing too many people going on TV or reading about, hey, now you should be buying stocks. You're not hearing that, which is a contrarian opinion. We know that contrarian is usually the side you want to be on. That works really well for you. You don't want to follow the herd or the crowd. Before you go to my office, because you're going to take my opinion, buy stocks, think I'm crazy, drag me out the door, feed me to the dogs, you may want to give this educational segment a listen. So I'm going to give you tons of facts and data that support my thesis. With that, let's welcome Mike Alkin, one of the best short sellers I know, and who is bearish on the markets, back to the show. Hey, Mike, how's it going, buddy?
What's going on, Frank? How you doing, pal?
I'm doing good. I heard. I don't know how I heard this, but I heard your podcast is doing well there. So, you know what? I want to start with that because we're going to get into your marketing, your opinion and stuff, but you know, you just have a recent great guest on, and I know that's gaining traction, and now you get your social media, you get more people listen to you, and you're going to get, with that increases the large part of the hate mail that you get sometimes and the crazies and things. But how you doing with the podcast? Welcome to the podcast world. You finally made it, man.
Yeah, Frank, you know, for somebody who spent an entire career in the shadows as a short seller, you know, doing a podcast was, if you asked me a year ago, would be the last thing I'd ever say. First of all, my personality is I'm more of an introvert than an extrovert. You mentioned social media. It wasn't until a buddy of mine who suggested I go on Twitter. I think it was 7-8 years ago, and I went on and then I didn't post anything ever. And then a year ago, he said, just start posting. So I did, and it's come out to be something that I really enjoy. But, you know, I have my name out there, which is something most people hide behind, something that's not their name. So I'm coming out of my shell, right? You hit 50 and hey, what the heck? You know, it's Mike 2.0. So for an introvert to have a podcast and to be vocal on Twitter, you know, I'm having fun.
No, that's great stuff, Mike. And the name of the podcast is Talking Stocks Over Beer, and it's getting a lot of traction now. And, you have a lot of great guests on. And it's really, really cool, more based on like the hedge fund community and things like that, and has amazing hedge funds that I don't see interviewed really anywhere. You may see that, Michael, but really, really good guest. And I wanted to throw out that at the beginning, but let's move on here because right now we have different opinions on the market, right? You think the market's going to come down a little bit. I think it's going to have a pretty decent year and be a little bit stronger. I wanted to talk to you about that because when I get feedback, and we did this podcast a little bit, I think a couple months ago, but I want to get more into detail because the recent conversation we had, this is a couple of days ago, I just thought, wow, this would be great to say on the air because even though we have different opinions, a lot of the stuff that we like and don't like kind of overlap, right? So talk a little bit about why you think the markets are going to come down. I want people to get your opinion, and even some of the sectors that maybe you don't like and you don't want, you choose to avoid right now that are crazy expensive.
Is that the conversation where I told you I thought you were smoking crack?
Yeah, it was the same conversation, which we're going to get to in a little bit, where we had a little bet about KU going further in Arizona, what you had to do. We'll talk about that in a little while, though, buddy.
So, look, yeah, I forget what you had said about the market or something, and we went back and forth, and that's what's great, right? Because neither one of us really know what's going to happen. So it is, my whole thing is I don't spend a great deal of time thinking about the market, but now I do in terms of what direction I think it's heading, and what that helps me do, Frank, is think about how to position myself. And now that I have subscribers with the newsletter and listeners on the podcast, how do you position your portfolio? I think there's times where you can. It's a blank canvas. Somebody can be 100% long the market, so they could have $1 in stocks exposed to the equity markets. And then or they could have more than that. They could borrow. They could leverage themselves up and have more than $1. But let's say you had $1, and you didn't add leverage. You could be totally exposed to the market, and that could be good or bad if it's going up or going down. But there's other ways to think about it. I could have some cash that I have in the portfolio. I could have 5% cash, 10% cash, 20%, pick a number, and or I could short some stocks, which reduces my long exposure as well, right? Because if I'm short an equity, I'm betting against the stock, so that reduces my exposure. So, to give you a quick example, if I had $1 in the market and 20 cents was in cash, I would be 80% net long, right? So I'd have 80% exposure to the market. If I had another 20% exposed through short selling, I'd be 60% net long. So the way I think about it, what you and I have talked about this, Frank. One of the things I see it a lot in the newsletter industry. Guys out there calling the market crashing. It's doomsday. Get your prepper kits going. Where the dollar is going to go away, and some of them tell you it's going to happen in 3 months or 6 months. Either they're brilliant, and I'm a dummy, or they're trying to sell newsletters, through fear. Because I don't know how you make that call. I like to be a little bit more sober. And by the way, I might be missing something, but since I've been reading them, most of them are always wrong. But eventually, a broken watch is right twice a day, right? When it's broken. So at some point in time, some of these people will be right. But in the interim, what happens to the people who are listening to them? So whether it was working at a hedge fund or writing a newsletter, I like to take a fairly sober approach to where we are in the markets, and then that guides me as to where to look. Now, I am a contrarian investor. That's my DNA, right? So you and I have different investment philosophies. You're more of a growth investor, which is great, and you can make money in markets, and I know how you pick stocks. So you're looking. Even in a tough market, you're looking for where growth is going to be materializing. I'm contrarian, so it means I'm taking the opposite side of consensus. And I don't do it for the sake of doing it. I do it where I have a view that has a variant perception to what the market currently has. Now, to have a variant view, you have to do some analysis. You can't, if you are a contrarian for the sake of being contrarian, you're going to go broke. Right? You can't disagree with people just to disagree. So you have to have some reason to do that. Since I start thinking about the market, and I will not forget it's March 2009, and I'm at a big hedge fund managing a portion of the portfolio, or having a portion of the portfolio that I'm responsible for, and stock prices are getting pounded. And you're sitting there, and there's not a reason in the world that you would want to step up and step in. But I kind of at that time looked at where stocks were trading and the valuations that they were at, and you start to notice what's happening to some of these stocks on bad news when bad news comes out? And are they continuing to go down at the rate that they had been going down? And I didn't call the bottom in March 2009. We didn't have meetings and say, ding, 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 this is it. But you started from that time, you started to see and you start to observe, because you don't want to be a hero, you don't want to catch a falling knife. And we still had a lot of long exposure to the market, but less than we normally might have had, because we were aggressively shorting stocks back then too. But what you started to see is you start to observe the market. And for me, I was very fortunate to work for a guy named Joe DiMenna back in the late 90s, early 2000 time period. And Joe is one of the great hedge fund managers of our time, manages many, many billions of dollars. And the firm was Zweig DiMenna, Marty Zweig, very famous economist and newsletter writer, started the fund with Joe DiMenna. And one of the things Joe always taught us was pay attention to how stocks react to news. And it's probably one of the things that always stays with me. So as I start seeing this, Frank, over the years now, when we had quantitative easing, we had a global coordinated central bank effort where everyone is buying, the governments around the world are buying bonds and driving yields down to nothing, right? So bond pricing and interest rates work inversely to each other. So as the governments are loading the balance sheets with buying debt, it's driving the price of interest rates down, which is then creating the need for people to take on a little bit more risk elsewhere and shifting money into the equity markets. So with that type of huge bid behind it, with accommodation like that, you start to see the equity markets just go up, and that's been going on for 8 or 9 years. Now you start to see the Fed talk about quantitative tightening, right? So they're not going to be adding to their balance sheet and buying that debt. So that's a massive tailwind that I look at and say, okay, well that's not there. Now we maybe we start to get towards normal price discovery, and price discovery hasn't really occurred in this market for decades. And real price discovery, natural price discovery, meaning somebody doesn't step in. We don't have somebody coming in and financially engineering what the buyers and sellers are willing to pay for something, right? A pure auction market. When prices are tumbling and the Fed steps in or the ECB steps in or the Bank of Japan steps in, they're putting a floor under it. That's not natural price discovery. And we certainly haven't seen that for the last 8 years. But now, with the Fed stepping off the accelerator, you have a lot of potential things that can happen. And I look at it and I say, okay, well, where's the market right now? You can make an argument, and depending on how you want to look at it, and say, well, it's the second most expensive market. And you could point to 2000 and you see the internet bubble. Where it was, but the internet bubble. I mean, the tech stocks were really grossly overvalued. But here, as I look across the universe of equities in many industries, things are really overvalued. So I look at it from that perspective. I say, okay, we've got the quantitative easing that is reversing now, and then I personally look at where a lot of these stocks are sitting, and I look at like consumer staples. I look at groups like the auto cycle. I look across myriad technology stocks. I look across myriad stocks and say, my God, why are they trading here? What, stocks really grow when earnings grow, when revenues are growing, and they normally have historical valuation ranges. And when I look across these universe of stocks, and I'll pick on the staples, when people who were normally equity investors or fixed income investors, and they were investing for income, when interest rates are down to nothing, when the corporate bonds they were investing in were virtually yielding nothing, same thing with treasuries, same thing with municipal bonds, they start to need income. So what do? They rotate into what they perceive as safe groups of stocks, What are those safe groups of stocks? They're all brands they know. And what's happened? You've seen the valuations go through the roof on these things. And at the end of the day, business hasn't gotten better for them on the margin. It's gotten worse. And at the end of the day, they have taken all of the extraordinary measures they can to try and get earnings growth. They don't really have top-line growth, so they go out and buy companies. They don't really have the ability to get pricing at the retail level. If you're selling into Target or Walmart or Amazon, you can't raise prices that much. So you cut costs like crazy. They've done that. So revenue growth is hard to come by. Cost cutting's already taken place, which means their margins have expanded. And then how else do you get growth? Well, you take advantage of your clean balance sheets and you go out and borrow a ton of money. And you borrow debt at very low interest rates. You take that debt and you go back and buy your stock back. And if you bought back stock, you reduce the shares outstanding, and you see your earnings grow. Okay, well, a lot of companies have added debt to their balance sheet to the point where they start to move into a range where if they were to add more debt to it, they start to affect their credit rating. And if it starts to affect their credit rating, it in the bond market, it determines how much they're going to have to pay an interest rate, right? So now they've got to be careful so they don't have that flexibility, and so that makes it really tricky. And on top of that, I think it's 40% of the companies in the S&P or in the Russell 3000, a real broad index of stocks, have their debt tied to LIBOR on a floating rate basis, and so LIBOR's doubled in the last year. So now that interest rate's adjusting up. If they have to go out and borrow new money, they're paying a lot more for it. And that interest expense is an expense that hurts earnings.
You brought up a couple of interesting points there. And one of them is that pay attention to the news. And I agree with you because when you see, like even during the credit crisis, like you brought up, when you saw a string of bad news, there was a point where stocks stopped going down to the bad news. And now what we're seeing, even companies the last couple of quarters reported good earnings, the average company that beat earnings fell the next day by 2%, right?
Yes,
which is a great point.
Last quarter, the average company that had a surprise in earnings of I think it was the average stock that had a surprise was up a little over 1.25% or so. In the fourth quarter, the positive surprises were the stocks were down 0.2, 0.3%. So, that to me, I look at that and say, okay, so now you've got this scenario where, okay, normally stocks, it's beat and raise. The beat and raise game, some companies are really good at it. Manage Wall Street's expectations. Let's put up a quarter that's going to beat expectations, raise our numbers, and stocks go higher. Well, it's really interesting. When you start to see that not happening, that's something that I say, wow, wait a second. Now that's more art than science, right? But it's
that's definitely art. That point, Michael, I definitely agree with you on. But you also said with earnings, I mean, we're going to see the strongest earnings growth we've seen since 2011.
Yeah.
And the conversation that we had was great because you said, but if you look a lot of you're talking about people taking out debt and buying back their stock. You're seeing, more companies buy back stock and, what the quality of earnings growth we were talking about. And I said, you know what? I made that mistake. 3 years ago, 4 years ago, when I said, wow, the buybacks, I was looking at companies like Nike and without buybacks, without adjusting their tax rate and doing different things. But you know what? The market didn't care. All they wanted to see is stronger earnings, right? They're not saying, well, how did you get to those earnings?
You were in the heart of accommodation. That's where I think you're in the heart of an accommodative, global, coordinated central bank policy, where money was flowing into the markets. For me, that's my view is it's kind of different now. Things are kind of changing. Let's pick on the consumer sector. What's the U.S. economy? It's 2/3 consumer, probably a little bit more than 2/3 consumer. So we could jump up and down in D.C. about bringing manufacturing jobs back. It's just not. It's not there, right? It's a consumer-driven economy. And to me, there are things that kind of don't make sense. I look at I look at the consumer and I look across what's going on, and I see that consumer lending growth is slowing. Right? I think I've talked about this on the podcast before, and it's interesting. You have a very good friend of mine going to launch a newsletter for you, Barry Cohen, and Barry and I were partners at Not Partners, KNOTT, for 7 years. We were one of 5 or 6 partners at a firm. It was a $4 billion hedge fund. Excuse me. And Barry and I have known each other for 20 years. And he's worked for some of the biggest hedge funds on the planet, Maverick Capital, Glenview Capital, Leon Cooperman. And he's a bank analyst and bank, insurance, financials. And, we could talk later on if you want about hedge fund performance, but that's for a different reason why hedge funds have been struggling of late. But in terms of pure intellectual firepower, sitting in those places, and it's crazy in terms of the amount of research that goes into analyzing companies, and in terms of pure bank analysis, I mean, Barry's a freak. He's what they look at, what he looks at, what he thinks about in terms of the economy and how it impacts the returns on equity of banks and the drill down that they do is nuts. And I've had the pleasure in my career of sitting there and watching guys like Barry. And so I choose not to be a bank analyst, right? Because that's they eat, sleep, and drink that stuff 24/7, and crazy smart. But I learned what to look for in banks and what to pay attention to. And I look across what's going on in the consumer environment, and I see record level lows of unemployment. And it's fantastic. People are working. But then I look at what sectors, what's going on. And what I'm seeing now is when I listen to the bank earnings calls, even though I don't analyze them, I listen to the calls and I listen for cues, and I know what to listen for because I had the luxury of listening to guys like Barry. And, I see consumer lending growth is slowing a great deal. Credit cards pulling back. I look at the auto lending cycle, and I look at subprime. What percentage of new car sales are going to subprime? Well, it's about 20%. And what's happening in that universe? What's happening in that universe is defaults are at global financial crisis highs. So how is that possible? Everyone's working. So everyone's working, yet subprime, big word, right? We all remember from the housing crisis, that is impacting the auto cycle. And so you saw a lot of people getting into the subprime business, a lot of people having loose lending standards, and it drove 20% of car sales. Well, as losses are approaching global financial crisis highs in the subprime area, what do? They cut back. So you're pulling 20%, not 20% of demand, but a lot of demand is getting harder for them to get a car. If they do, they're going to pay a lot more interest rates, a lot more in interest. And when credit card growth is starting to slow, credit card, what's happening there? Is it not? And you're not seeing the losses on the credit cards, but the demand for the growth. So is it people are saving more? Well, if they're saving more or paying down debt, that's not working its way into the economy. And I listen for cues on the call. So it's not a Goldilocks environment for them. I look at gas prices. If the subprime consumer is struggling, and gas prices now are as high as they've been in 2014, right? We don't really a middle-income person might not recognize that. Oh, God, they go to the gas tank, they look and say, oh, geez, look at that. Got to pay a little bit more. But if you're a lower-income consumer, gas prices that make a huge difference in how you live your life and week and how much you spend on food. It makes a real difference. So I look at that, and I know this summer at the pump, they're going to have a sticker shock they haven't had in 4 or 5 years. I look at the insider buying of executives at companies. Right? People sell stocks for a lot of reasons. They buy stocks for insider. Right? They sell them. They might have to pay for taxes. They might have college education. So I think a lot is overblown when people look at insider selling of insiders and executives and management. But I look at it now, insider buying, when people step up to the plate, that's telling me that they have a lot of confidence in where they are. And there are windows when they can buy, but they're still insiders, right? They see, they feel, touch, they know what's going on at the company. It's half of the 10-year average. It's at 12%. The 10-year average is 26%. So if I were to look at them for cues across the 4,000 companies in the U.S., they're not stepping up. They're stepping up at half the rate they were stepping up to buy stocks at the last time.
I want to make it clear, you're not like a perma bull. I'm not a perma bull. You're not a perma bear. We just look at different market conditions, right? I mean,
on this podcast, like I talk about, am I bullish or bearish? Do I have a view on the market? Yeah, I have a view. Am I bullish or bearish? I'm more bearish now. Do I tell people that they should be taking advantage of big moves up in the markets to lighten their portfolio? Yep, I say that to my subscribers, and I say that on the podcast. And I spend on the podcast probably 3 minutes of doing that, and I think since early February probably I've sent out 2 or 3 or 4 email updates talking about, here are the things I'm looking at. Here's why I'm more bearish than bullish. Here's why I think you should be prepared. Because I just think that it's easy to be lulled into thinking buy the dip. It's easy, right? For 8 or 9 years, and if something went down, it came straight back up. So I think it's just important for people to start to have a mindset and point out to them the things that are going on that might not make it so easy to make money in the stock market. And for Frank, it always comes down to one thing: the risk I'm taking for the reward I could get.
I want to get some of your stock picks and the reason why we'll have them, because I'm going to outline my reason after this of why, I think stocks are going to go higher. And I want you to outline like why you think, why you're nervous about the markets and come down. Yeah. But I wanted to shift the attention to also different ideas, because a lot of the ideas that we share are kind of like similar, even though we have different opinions of the market, which is kind of weird. And there's, you've given us I'm not even going to say it because I'm going to jinx you. But the stocks that you've given us so far, since I've had you on this podcast, have almost every single one of them have been winners and big winners. A lot of those were shorts. But I was talking to you about one short in particular, and this is what I love about your analysis, where when you see, and I always say this, guys, the worst people listen to are perma anything, because if you're a perma bear and the market goes down 80%, you're going to say it's going to go down another 20%, 30%, 40%. But with you, one of the shorts that you picked, and I'll let you tell the stock, which you nailed, which is down 50%, which you came on my podcast, I think it was like 9-10 months ago. Now it's come down to a level, and you actually said, you know what, I think this company's a strong buy now. I mean, it's amazing how you flip. Could you talk about that stock and maybe a couple other ones that you like, even from the short and long side?
Yep. Yeah, I like you said, Frank, perma anything is, aside from having the working for Joe, MBA, PhD, you name it, watching one of the best hedge fund managers on the planet ever in real time, working for him all those years ago, things stick with you. And so in terms of how they mention news, how they react to news, another great takeaway was I could be long a stock today, short it tomorrow, short it, long it tomorrow. Because it comes down to expectations and valuation and what are you getting for it. So this particular company, it was Newell Rubbermaid. I think I came on your podcast, I don't know, the stock was $53, and I had followed the company for many years. I have some things that I have mental models in my head, and I always pay attention to roll-ups. And roll-ups are companies that grow their revenue by acquiring a lot of other companies. And early on in the life cycle of a roll-up, they work because Wall Street loves growth. So they may not grow organically, meaning internal growth, from selling more stuff or higher prices to more customers. They go out and buy it. And as their stock price goes up, they have expensive paper stock to go issue for the acquisition. And a lot of times they issue a lot of stock, they do a big deal, and it keeps feeding off itself, and they become Wall Street darlings. Well, one of the things I've just learned over the years is they roll up and then they roll over. But it's hard to figure out when that's going to be. And then I started sniffing around and I started looking at it. I saw the numbers and some things didn't make sense to me. And I did some work, and I think I talked about it on your podcast. I won't bore people now, but I started to look and I said, holy cow, they have a business in Venezuela that's making up a big portion of their revenue growth, and it's making up a big portion of their margin growth, and it's less than 2% of sales. And because of funky inflation accounting, they were able to get the benefit of this, nothing improper, but because it's only 1 to 2% of sales, they don't have to talk about it. No analysts are paying attention to it, because 1 to 2% of sales of anything doesn't make a difference, right? Until it does. And in this particular case, they had the benefit for about 3 years of really funky one-off type stuff that allowed them to get their earnings going. And as I started looking at it, I said, wait a second, this doesn't make sense. This is a crappy business. Nobody's talking about where this earnings growth is coming from. The eye is completely off the ball. I'm really interested. And then what happens? One day I wake up and they bought a company called Jarden. And Jarden was a roll-up consumer products company that I think was the number one performer in the consumer product space for years. They bought mundane brands, household matches, playing cards, you name it. And I watched this company for a decade, and you had to be suicidal to short it because it was a great roll-up game. But what they did is they would buy companies, and they didn't reinvest a lot in the brands. So they would buy a company, issue equity, and then starve it of advertising and promotional expenses. I know from doing a lot of consumer analysis, that's not good. When you're starving brands and you don't reinvest and don't give them time to grow, it's just a matter of time before those sales start to suffer. But if you keep buying more and more companies, nobody sees it. So I knew from watching Jarden, in the prior year, they had done 2 huge acquisitions back to back, and way outside of what they normally did. That was a red flag for me. And then they missed a quarter. These guys never missed a quarter. And then shortly thereafter, they sold themselves. That told me, okay, these guys they're sharp operators. They know how to play Wall Street, and they were very good at it. Get their stock price up, all legal, of course, but just playing the game. And I knew that when Newell had to change their accounting, like a lot of multinationals had to do for Venezuela, that now they didn't have the benefit of that little tiny business showing this big growth, and they had to do a big acquisition. And when they bought Jarden, I thought, wow, these guys would only sell if they knew they had nothing left. They did. And then what did you see? They merged, and Wall Street fell in love with it because they got up there and they said, we're combining 2 juggernauts who had one had a massive turnaround in Newell, and the other one is, look at the track record they have. And what happened? The sell side knew that there were going to be more deals to come, and the sell side knew that they were going to get banking business, and everyone fell in love with it. And the stock was on a tear. And I just knew it was a matter of time. So I did the work, and I said, wait a second, I think earnings, I sort of laid it all out in a model. I think the sell side is out of their minds. I think the company knows they have a problem. I was talking about it on your podcast. I recommended it to my subscribers. And, shortly thereafter, they missed a quarter, and, fast forward, that was the summer last year. Fast forward 6 months later, stock got cut in half. Now, that being said, it came down to a point where I think it's kind of interesting, right? So then I see Starboard Value, an activist fund, came in, and they wanted to overthrow the company, overthrow the entire board, and they were going to run a proxy battle. And I know that that put the company on notice. And when you Jeff Smith at Starboard Value had some good luck in some prior things before, and he did okay. And so that kind of piqued my curiosity, and I watched it. And then I saw Carl Icahn had filed on it. And, Icahn is at a different level than Starboard Value. Starboard Value is very good, but Icahn is one of the greatest investors in the history of the world with his performance. And he used to be a corporate raider. And he'd go in and raid company. He did it in TWA. He'd be an asset stripper, but way back when, right, in the 80s. But now he's taken on a smoother kind of investing. something, and he's an activist. He goes in, he rattles the boards, he rattles management. Managements get scared shitless when he comes in because they don't want to lose their jobs. So they tend to play ball with him. So I look at the stock that got cut in half. I look at the expectations that are washed out. Nobody believes it will do anything. All the guys who were bullish on the sell side now come out and after they've blown up and say, "Oh, this is terrible. You can't invest in this company." Okay. Now you got Icon in there. He's got people on the board. Starboard Value just came back in, and they want more done too. And now the bar is so low, a lot right doesn't have to go on for this stock to move a lot higher. So that's kind of, I could be long something one day and short it the next. So that's kind of how I did it.
No, it's cool. And I know that I don't want you to go over some of the auto stocks or things like that and consumer staples because I know you're doing a lot of that in your newsletter and stuff. But, yeah, the point of this interview is just showing there are pockets, even if you're bearish, that work, and there are pockets that are not going to work. Because even with you, Mike, I mean, you were shorting these stocks when the market was bullish. This stock and Dean Foods, two stocks that you gave before you started a newsletter on our podcast, where these are two names that really got crushed where the market was going higher in 2017.
Frank, you worked for a guy for 5 years, Jim Cramer, who said, one of the things he's famous for is, there's a bull market going on somewhere. I got to go find it, right? Well, translate that into there's a bull or bear market underneath in the subtext of the whole market always going on. And if you're so you just got to go find value, or you got to go find fundamentals that are going to start to decline. And now, on a broader context, it's how do I want to position my portfolio? That's why I say, sell a little bit, lighten up. I think the market's going down. Here's why. But it doesn't mean that you can't own stocks. You just got to know what groups of stocks you want to own. For me as a contrarian, I'm looking for stuff that they're so blown up that their expectations are so washed out. When the market goes down, if you can catch it's just not that bad type of stocks where the valuation supports them, they're going to hold up better or go up.
That definitely makes a lot of sense. Now, last thing I want to mention to you to close this out is you are a big Arizona fan. I'm a big Kansas Jayhawk fan, and we had a little bet going, didn't we? I forgot what that was. What was that bet, if you wanted to remind? I forget.
Frank, I think so.
You forgot too, right?
No, yeah, the bet was something. So, yeah, I initially started off. I went to the University of Arizona, but I'm a diehard Arizona Wildcat fan. It was a tough year. So they were embroiled in the FBI scandal with bribery allegations with college basketball, but a really talented team. And so you're a huge KU fan, and and we bet that Arizona would go deeper into the tournament. And I forget what was the bet because I lost.
I remember the bet well, but I was just surprised that bet ended after the first day.
It was Frank. It was. I had a tough week. I was really bummed out. Now I do feel tough. A little better today. I have to tell you, because I did read that KU is now in the same company as Arizona, allegations-wise, from a college basketball bribery scandal.
They didn't bribe anybody. They just paid Adidas to, right? What are you talking about? Wasn't us, right? This doesn't go on with every college basketball team. It's so amazing. But anyway, I think that bet was you had to sing a song, and I won't hold you to it today, but I am going to hold it to where we got to go on the podcast, and I was going to sing your song. You're going to sing our song.
I have to sing, is it the Rock Chalk Jayhawk? I have to sing the Kansas. Do I have to sing the Kansas song? Is that what it is?
The Kansas. Yeah, I'll send you the lyrics. I'll send it to you next time.
You send me the lyrics, and I promise you, on my podcast, I will sing it. I will devote it to you.
All right. You got it, buddy. So listen, I'm going to end it there. Guys, hopefully you got a lot of this podcast. It's mostly a lot of this interview where, listen, it's okay when you see two different opinions. It's not like one's right, one's got to be wrong, but you have to understand the underlying fundamentals of each single sector matter. And some sectors are going to do good, some sectors won't, and sometimes you can see the market go down 5%, but yet some certain sectors and certain stocks can go up 20, 30%. We've had stocks that have gone up in 2008 and 9 as well. And that's what you should be looking at, focusing on the underlying fundamentals, and no matter which direction you think the market's going, like you said, it's always Frank, a bull or bear market at some place.
Now, one last thing, Frank. You and I, right? We work under your umbrella. It's the Curzio Research. So I've heard some people say to me, "Frank's bullish, you're bearish. How could that be?" Right? that doesn't matter. You have a view, I have a view, but we're not dogmatic and fanatical about that view. It guides how we think about the markets. And like you said, you can have a really bullish view and know when to not be in the stock, and I could have a bearish view and know when I don't want to be short something. It's you just gotta put everything in context.
No, it definitely makes sense, buddy. So listen, I really appreciate you coming on, and good luck with your podcast. I know it's on fire right now. You're getting a lot of viewers, and we'll definitely have you back on soon, buddy.
Thanks, man. Take care, Frank.
Hey guys, great stuff from Mike. Hopefully you got a lot out of that interview, just showing, what sectors are people like, what sectors don't. I thought he brought up some really good points. This is why I always have people on that have a different opinion than me, because one of the things that he said that stood out to me, which I thought were great, was how the markets react to news. And right now, even the positive news, especially last quarter, I think it was like 1.4, 1.5% the average stock who beat earnings. That's what it fell the next day. And if you missed earnings and you were like Walmart, you fell 10, 11% in one day. So when you're not seeing your stock go higher due to positive news, it kind of signals that maybe there is a top. But with that said, I disagree when it comes to the earnings growth, the sales growth. And that's what I'm going to get into right now, explaining, because that's why I let him go a little bit with his thesis. This way you get my thesis and you understand. It doesn't mean that you have to go completely long in the markets or completely short in the markets, but it's good to get a perspective, because I learned what he's thinking of from, okay, maybe I shouldn't get too excited. And he's learning what I'm thinking of. Maybe I shouldn't get too excited on the downside. And it really adds, and it's hopefully this is coming over good, because it really adds to the analytical part of making the right decision. That's what we want to do here, making the right decision for each stock, for each sector that we invest in. And you do that by getting both sides of the story. You don't do that by everybody talking about the positives, like when he went over with Newell and the whole sell side loved that. You do it by sometimes being a contrarian. That's another thing I disagree with him. I think the contrarian investor is more being bullish in the market now than bearish, because I'm just seeing everybody bearish on the markets. And let's talk about that right now, because when I look at the markets, I see three major risks. Outside that, President just tweeted that we're going to, send missiles to wherever, Syria, wherever we want to send missiles to this week. Next week will probably be someplace else, right? So I pushed the markets down a little bit, and that's on Wednesday. Now, the three risks were trade wars, right? So trade, tariffs, which I said this is going to be a story. It's not going to exist 3 months from now. I'll go in a little bit more to that in a second. Also, we have rising inflation, which is a worry, and rising interest rates, right? Two things that usually don't bode well for stocks. But when you break down those risks individually, and the reason why I said this about the trade wars is we have the EU, we have China robbing us blind. Okay, now you always have to, I had a whole segment on this, put your political differences aside, they crush it. This is why we saw China blink. They had a blink. They have a surplus. What does that mean? Because sometimes it doesn't register. Well, 20% of China's exports go to the U.S. 20%. That amounts to $505 billion. Yet, if you look at what we're sending into China, right, what they're importing from the U.S., that number is about $130 billion, maybe a little bit more than that, but it turns out to be a $375 billion deficit. Hopefully those numbers add up. I'm just, again, doing this on the fly. I've done a lot of research on this. But you could see the massive impact that if we shut our markets off to China, what that would have. And how you shut it off, you raise tariffs, you raise taxes, you impose tariffs on different goods. And we want to make that trade fair, because we're getting taxed like hell. It's not called taxes, right? It's not called taxes, but it is called value-added tax. And they also charge general sales tax. So when you're looking at these two things, right, everybody's used to saying tariffs, but if you look at Canada, the value-added tax combined with, again, I'm going to combine both of these guys, the value-added tax with the general sales tax. We're talking about between 11 and 15% they're charging us. China charging us 17%. Egypt, 14%. France, 20%. Germany, 19%. I want to thank my buddy Steve Kumar for providing these figures for me. He had this in his Vigilante Investor newsletter and talked about it. But you're not seeing that mentioned any place, because they're like, no, we don't do tariffs. No, instead you just call them VATs and GSTs, right? Instead. So we're getting robbed blind, and we put a stop to this, right? Maybe we could have handled it other ways or whatever. But the bottom line, it's China and the EU, unless they want to see their economies go into recession almost immediately, They have to comply. And behind the scenes, they are. They're negotiating. China came out and said, well, we're going to raise tariffs on, and it turned out to be 1/100th of our GDP, right? Why do they have to do that? Because this is negotiations, right? You need to save face. You can't have a country, the U.S. can't, slap someone in the face and say, hey, you know what? We're going to do this to you and you better take it. If the country does nothing, what is that signaling to the rest of the world? That, hey, you know what? We're not tough. We don't care. We're letting people bully us, whatever it is. You have to try to save face. So when China came out, we saw the market come down by 700 points. And this was last week when they came out and said, hey, we're going to raise tariffs on your, again, it counted such a small percentage, but it was more of a reaction of, hey, we need to save face. But there's negotiations going on behind the scenes, and it's going to work out. So you look at a major risk that pushed stocks down tremendously, probably a good 5-7% of its highs. A lot had to do with trade. And that story is going to be non-existent 3 months from now. It's going to be non-existent, just like, think about all the risks we talked about. Brexit, you're looking at credit crisis, housing crisis, collapse in housing prices. An oil shock. Think all the news since over the past 10 years that has happened with everything going on. How many terrorist attacks? How many, huge natural disasters. Some of the biggest in the world, right? The amount of money we paid natural disasters in 2017, I think, was a record high in terms of insurance claims. So you're looking at all these, we don't talk about them anymore. They're gone, right? They're gone. Stocks recovered. They digested this news, and they're going to digest the trade news. It's not going to be an issue. It's in everyone's best interest to make it fair. It will be fair, and it's that simple. Okay, I don't care what side of the aisle you're on. I don't really care if you're a Democrat or Republican or whatever. I'm just telling you from a stock perspective, which is what this podcast is about, and why you want to make money. If you want to make money, you shouldn't care about trade. There's no trade war, and there's not going to be a trade war. Okay, it's not in anyone's best interest. It just has to be fair. That's why China blinked, which we said was going to happen 3, 4, 5 weeks ago. And we're going to see the EU do the same thing pretty soon. That's going to be taken care of. Now, let's go on to the other two risks. The other two risks are rising inflation. And that uptick in inflation is scaring people. Inflation is viewed as a negative when it comes to the stock market. The idea is that higher prices lead to fewer goods being purchased by consumers, resulting in a decline in profits and much lower stock prices, right? Because that's what it's about. It's about profits. See profits come down, then you're going to see stock prices come down. Usually when you see core profits go higher, you're going to see stock prices go higher. Normally you see that. But inflation is not bad. Unexpected inflation is really bad. And we're pretty aware of that. Everybody's talking about it. It's being mentioned every place. And that's going to catch people off guard. And if you see that, not people, but also companies, if you get caught off guard with much higher inflation, that makes it more difficult for companies to pass these costs on to consumers right away, and that would really hurt profits a lot quicker, and that results in a steeper loss. At least stocks coming down even further. We're not in an unexpected inflationary environment right now. Inflation has been gradually rising, which is fine, right? So you see it rising, and that's why the Fed's saying, okay, that's why we're gradually raising rates. The economy looks good. Inflation's going higher. This we expected 5 years ago. It didn't happen, but it's happening now. But you really look at the numbers of inflation, it's amazing that people are worried about the levels it's at, even if it goes higher from here. Because if you go back to 1913, which is pretty far, I'm not just picking a random date, but that's what, your inflation rate going back is just, that's where they really started tracking the numbers back then. So you're looking at it dating back to 1913, the average inflation rate is 3.2%. Right now we're sitting at 2.1%. So more than a full point lower than historical average. And then if you even take a period from say 1950s to today, if you look from 2014, inflation has been going higher. But if you pull up almost any chart from the 50s from 1913, you're going to see we're relatively low when it comes to inflation. You just have to look at any line, any chart. You can punch up to Google, punch up inflation rate since 19 whatever. And when it comes up, click images, and you're going to see a whole bunch of charts that you can look at from, just all pictures of charts and stuff like that. So when you see that, you're going to see, wow, even though we've come off our highs from inflation, it's still kind of low. And if you compare it to last year, we're lower on our inflation rate. So last month's inflation rate compared to last year, we're actually low. high last year at this time, which is kind of weird with everything you read, right? It doesn't really make sense. So when you look at inflation as a whole, as long as we don't have unexpected inflation, which we don't, and it's being monitored, I don't really see that as a risk. As long as it's being monitored, as long as we're not seeing it get out of control, and again, it's lower, much lower. I think it was at 2.7% in 2017, and we're looking at February. I think it's the last available data, compared to 2.1, 2.2%. So I think those fears are, when you look at the fears, are kind of overblown. Yes, we're seeing high inflation. We're not seeing crazy high. It's the first time we're seeing inflation rise in such a long time because it's been low and we thought all the stimulus would happen. So now what's the Fed doing? The Fed's gradually raising rates, which is fine. Now, is that a risk? Yeah, well, company, after they finish their tightening cycle, it's usually a sign that, again, it's more expensive to borrow. You see mortgage applications go lower, right? Because when lower interest rates, more people are going to try to borrow money to buy houses, and now the interest rate's going higher. But what people don't talk about is during that environment, we usually see home prices go high, and home prices are skyrocketing right now, and they're going to continue to skyrocket, guys. And it's not a bubble. There's just not enough supply of houses out there. There's just not. And people are building houses. It will balance. The pendulum will swing to the other side. There'll be a time it's not going to be a housing crisis because, the subprime debt in housing is a lot lower than it's ever been. And the banks are not allowed to lend like crazy right now. It's a lot more tightening structure when it comes to the banks and the more conservative. But you will see probably home prices fall. It might happen 5 years from now. It's not going to happen before that. I mean, I think house prices are going to go higher. I'm looking at my neighborhoods. I have good contacts throughout the real estate industry throughout all of America from this podcast that I talk to. Nobody's telling me home prices are going lower. I haven't heard that once. If you have, email me, Curzio, Frank at CurzioResearch.com. Send me an email. I want to hear from you. I haven't heard that from anybody. Oh, housing prices are really starting to decline on area. No. You might see rental incomes decline a little bit. They've been going up. Anyway, but if we're looking at rising interest rates, still relatively low compared to historically. Even if we continue to raise a full percentage point from here, which is going to be what? Takes to 2.5, 2.75 in short-term rates, even at that level. That's considering that they're going to raise by 0.25% increments every 3 months, right? So a quarter percentage every 3 months, that's what they're planning on raising. So a full percentage point in a 12-month period would take them to 2.5, 2.75, but that's still relatively low to historical standards. And we're looking at a rate that's more 3%, 3.2%. If you're looking back historically on average, and this is dating back for the 1960s. So I spent a ton of research over the past 3 weeks, all market research, all data, all this focus. So what does that mean? It means that trade fears overblown, right? These are the main risks that are causing the market to come down. You're looking at rising interest rates, not a big deal, as long as they're not unexpectedly rising, which we'll know because we're monitoring the data every month that comes out. You look at the Fed raising rates, to control inflation, but inflation does, we'll see what inflation does. I don't think it's going to – if you're looking at wages, if you're looking at technology when it comes to fracking, you're looking at technology when it comes to robotics, big data analytics, cloud, if we're looking at technology products, semiconductors, I mean, pricing is in check. Okay, you could say, okay, healthcare is going through the roof. Yeah, you're right. And education tuition is going through, but there's a lot of things where prices are maintaining the same levels. So as long as wages are stagnant, which they are, and people say, well, that's a bad sign of the economy, I don't think we're going to see inflation go out of control. So I don't see inflation being a major problem. And interest rates, everything's expected. It's on the table. We're talking about the Fed's telling you exactly what they're going to do over the next year. So a lot of this stuff is priced into the market, especially if we're all talking about it, people are writing about it. And what does that bring us back to? Well, it brings us back to earnings. And earnings are growing and grow this quarter at the fastest pace in 7 years. I look at 17% earnings growth year over year, which is incredible. And you can't just take earnings growth and say, wow, it's earnings, it's tax reform. Sales are growing by 7%. Profit margins are increasing year over year. So this isn't just, hey, tax reforms, and this is, a bogus way of increasing. No. And we're seeing it across the board. We're seeing strength across the board. And from my experience being in this market for over 20 years, it's rare to see a continued bear market. And this is why I disagree with Alkin and a lot of other bears out there. it's going to be difficult to see the market continue to come down if you're seeing this kind of growth in earnings. And we're supposed to see it this quarter, the next quarter, for at least 6 quarters, maybe 8 quarters of double-digit earnings growth, which is incredible. Now, what are we going to see? We're going to see incredible volatility, of course. Markets going up, markets going down. And that's the key to everything, this whole entire podcast, is when you have this massive volatility and disconnects in the market where you're seeing energy prices pushing towards $70 a barrel, and yet oil stocks are trading lower than when they were $4 a barrel, when almost all these companies who survive push their debt out, their balance sheets are better, they generate massive cash flow because they could drill almost anywhere in the U.S. at 50, 55, and we're at $65 a barrel oil. And this is a sector that's ripe to explode. I mean, you're looking at energy being the top all 11 sectors are going to see growth, earnings growth. Every single sector. So the 500 companies, S&P 500, they're all filtered down. It's 11 sectors. Every one of those sectors are going to see high growth, which is amazing. Now, if you take next year's earnings, expected earnings, which is around $174, and you take the S&P where it's trading today, you're looking at the S&P 500 trading at 15 times forward earnings. 15 times forward earnings. Yet the whole world's telling you stocks are expensive. You got to be careful. It's about earnings. Don't look at where the S&P went, where the Dow Jones, how high it went, because the stock market could double in 3 years. If earnings triple over the same time period, the market's going to be cheaper even though it's up because earnings are growing faster than the overall market. It's important for you to realize that because people say, wow, the market's up so much, it's expensive. No, it doesn't mean it's expensive, especially if you have that earnings growth. And why do you think Microsoft traded 70 times earnings 15 years ago? What does it trade today? About 15 times earnings? What, 10, 15, 20x? Because they're generating more earnings now. And more sales. So you're looking at 15 times forward earnings. What does that mean? Well, the historical average is 15.5 times. That dates back to the 1950s when the S&P 500 became 500 companies. And even if you take the 5-year average, it's 16.1 times. So we're trading below our 5-year average right now, yet the whole world's telling you that stocks are very expensive. But they're not. Not all stocks are cheap. You look at technology. A lot of these stocks are through the roof. Momentum names, you have to be careful. But there's a lot of names out there down 20, 25%, blue chip names that are fantastic buys. If you're a Curzio Research advisor, remember, you know what I'm talking about. I just came out with an issue highlighting a lot of these statistics that I've gone over and done a ton of homework on a 13-page report, but I also gave you a large cap stock that I love that's down tremendously. That I think has incredible growth. It's going to see incredible growth. It's dirt cheap. And a lot of problems it had to fall 30% no longer exist. And half of that was because the market came down so much. So start looking at blue chip names, good names, even the energy sector that have fallen down. You're going to find names down 15, 20%. And you know what? A lot of these names are not expensive. A lot of them have growth catalysts over the next couple of years. And this is becoming one of the best markets that I've seen, probably at least in the last 5, when it comes to finding new ideas that I like, both on the long side and, as Alkin mentioned, even on the short side. I've said this before. It's finally becoming a stock picker's market. Okay, it's not like, oh, okay, let me just buy the whole sector and everything's going to go up. Let me just buy the market. Any stock is going to go up, or this is going to go down. It's very selective, but for me, the stocks I'm looking at, just like Alkin, a lot of the stocks that he's looking at, especially consumer staples and autos, which I agree with, 2 sectors I think are ripe to crash. We're finding a lot of good ideas right now. I think it's a good time for you to make money if you're smart. But for people telling you that you got to be careful, the market's crazy. Look, I just highlighted 3 major risks that I don't see as major risks. They're all in front of us. Trade's not going to exist. We're all highlighting how inflation is going high. We all know about it. Interest rates are going high. We all know about it. I don't see those risks as priced into the market. And yet we're looking at a stock market that's going to see incredible earnings growth, not only just in this quarter, but going forward. Now, you may say, Frank, it's earnings growth. I don't know if that's enough evidence for me. Let me tell you something. Let me highlight a few more positives. I know I'm running late here. But if you look at Evercore is a good research firm. They came out with all kinds of estimates. They believe this earnings season, right now, FactSet's predicting 17% earnings growth. They're predicting 25% earnings growth this quarter. That's a lot. I highlight how companies are increasing their dividends 10% on average. Companies don't increase their dividends unless they're confident on that they're going to have a pretty good year or a good 6 to 12 months. They wouldn't raise their dividend by this amount, which is close to record amounts. Homeowners, right? The home prices are going through the roof right now. Homeowners are sitting on $5.4 trillion in cash or tappable equity that can be used to buy stocks. It can be used to fix their homes. Either way, use for money that they could borrow that they'll spend into the economy, which is good for the economy. $5.4 trillion. Remember how negative we were at 8, 9, and 10, how crazy it is? Now, with all the new houses being bought, most of them, not all of them, you have to put down 20%. And not only did you put down 20%, like I had to do when I bought my house in 2010, but the home price increased significantly, and that's all that equity in the house. A lot of people have seen the same thing, especially if you bought your house over the last 5, 6 years. You're looking at liquidity. Guys, the amount of deals is insane. Santos, buying Harbor Energy for $10 billion. China Costco Shipping taking over OOCL for over $6 billion. Walmart buying PillPack for $1 billion. A lot of these were highlighted by Evercore. And Centrum Group to sell money exchange business to Ebix for $185 million. We get $300 million deals getting done like nothing. What's not highlighting that research report is the recent Sprint deal and talks with T-Mobile, multi-billion-dollar deal. Google buying Nokia's broadband business. Analogic being acquired by Alteris Capital for over $1 billion. Apollo about to raise $4 billion for a third fund, which is focusing on natural resources. They're going to raise it easily. Icon selling Federal Mogul to Tenneco for $5.4 billion. Novartis paying $8.7 billion for Avexis. You have Verifone being bought by Francisco Partners for $2.6 billion. Guys, I'm highlighting these deals not to bore you. But these aren't deals from the past 12 months. These aren't deals from the past 6 months. These aren't deals that have been done in 2018. These are deals that were done in the past 4 days. The past 4 days. You don't see an M&A market like this in bear markets where people are spending this multi-billion-dollar deals in the past 4 days. I mean, there's more. I can highlight even more. So I'm not telling you to close your eyes and buy the market. It's going to go high. What I'm saying is I think the market's going to have a much better year than people think. Everybody thinks it's going to have a negative year. But don't let that discourage you from finding these stocks that I'm looking at that are trading below market multiples, huge growth, down 25%, 30%, and even blue chip names and a lot of small cap names. I don't have to worry about trade fears because they don't have international businesses or sell it overseas. There's a lot of good ideas I'm finding. If you could ignore the headlines, ignore what's out there, you're going to find similar ideas. So if that segment came off good, it wasn't too long for you. But again, I want to highlight some ideas that I'm seeing and give you an opinion on both the bullish side and the bearish side. This way, you can research yourself and determine which way you want to go. But definitely look for ideas. There's a lot of good ideas out there that I'm finding for the first time, like I said, in over 5 years. Okay, guys, be sure to check out my Curzio Research Facebook page where I post live videos. I just posted a couple last week. I'm posting a lot more because I have I've been learned how to use a new system called Buffer, where I can post things to all my social media accounts at the same time, which is a lot of fun, which is really cool. So I'm posting on all my social media accounts, especially Twitter as well, at Frank Curzio is my handle. Posting there a lot more lately. And again, I just have strong opinions. It's a lot of fun. But 2 outlets, guys, if you're new to the Curzio Research brand, you can look at it, find our stuff. We have a lot of free research. You can find a weekly breakdown, a podcast, transcripts, and all stuff like that, which is really, really cool. So, be sure to check those out. And, again, we love to offer a lot of free stuff in hopes that you guys trust us enough to really buy our paid products, which are really, really good. And we work really hard on there. You'll see the research is better probably than anyone else in the industry. And it's been that way since we started this company over a year ago. So I appreciate all that support. And if you have any comments, questions, need someone to yell at any time, get your frustrations out, even if you disagree with me, feel free to email frank@curzioresearch.com. That's frank@curzioresearch.com. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.